How are you now? Broadcasting from the VFS studios at Northbridge in Sydney. You are listening to the all-new BIP Show Season 5, Episode 10. Phones on silent, please. Don't forget to hit subscribe and rate us wherever you get your podcast. And a reminder that all the financial information in this podcast is general in nature. Only speak to a professional advisor about your needs. If you don't know what general advice is, stick around because we're probably going to have someone who'll be able to help us work through exactly what is going to be changing in that area as well. I am James Whelan, investment manager at VFS Group. I believe Paul Colgan has cleared customs coming back from Davos, but is struggling to find a cab back, and the trains are on strike. We wish him all the best on his journeys. This episode is being recorded, as mentioned, in Sydney. The date today is the 9th of the 9th, 2022 AD, and the time is 9:05 in the AM Australian Eastern Standard Time. We will continue to remain unsponsored until such a time as we have an alignment that every single anonymous person on the internet is okay with. I really pay attention to what you say. Don't forget to subscribe to the show, rate us, and leave a review wherever you get your podcast. I'd like to also take this opportunity, if I may, to pay respects to the passing of Her Majesty the Queen. Black armbands are on here at the BIP Show HQ, and a few glasses will be raised once it is a slightly more appropriate time to do so. Huge lineup of guests today, so let's just get cracking into it. First off, we've got Kyle Rodda from Ausbiz. He's going to be talking about the week that was and is, interesting guests they've had. We've also got we've got tech guru John de Boer. He's talking about trends in tech and recruitment and all sorts of fun stuff that's going in there. We've also got Ian Aspinall, head of sales and relationships at OpenMarkets, I believe, unless that's changed in some time in the last 10 minutes. He's going to talk about some of the changes that have been coming up in the advice section. Big, important for anyone with a super fund, anyone who gets advice, anyone who gives advice. He's going to tell us it's going to be good because I've seen the changes that have been made. I haven't actually had a real chance to get down and get dirty with it. So hopefully Ian will be able to help us out with what's going on in that one. Right, first off, we've got, I'm going to do this in non-alphabetical order, checking attendance. I've got Kyle. Kyle, how are you now?
Good. How are you?
Not so bad. Aspie, you're on the phone too. You good there?
I am. Thanks, James.
Mate, your levels are coming in fine. Now, Kyle Rodda from Ausbiz, let's go through your guest list this week. Who was hot, who was not? What was some interesting stuff that came out of your Ausbiz experience, apart from the fact that you have the spicy cough?
I do have the spicy cough, although I got so far I got through it pretty well, actually. Very, very mild. So apologies to any guests who may have come in Monday and Tuesday when I thought it was just a little bit of hay fever and might be stuck at home themselves now.
Yeah.
But
it happens. You get that on the big jobs, mate. It's going to be okay.
Yes, but no, all's well. Hot and not. Well, I'll stick to the hot because I wouldn't want to besmirch anyone. And we don't do not at Ausbiz. It's all hot.
It's all hot, yeah.
It's all hot. But I mean, it's hard to go past two things I think during this week. Just top line kind of stuff. Post-mortem when it comes to earnings season, and no one can really tell me whether it was a good one or a bad one. Good people who say that it's good is that, earnings were largely better than expectations. Bad ones, maybe a lack of guidance, and perhaps, we're sort of looking still potentially at a, sort of earnings downgrade cycle to come. But also there was the macro stuff that was really, really prominent. Best interview I think I saw, and again, I've been off for a couple of days working from home, so I haven't been able to talk directly with folks. But my favourite interview for the week so far was Stephen Miller from GSFM. I always mess up the business's acronym there.
Close enough, mate. I'm VHS to a lot of people on your show, so it's
VHS, yeah, great vintage. But basically, his key point, and I do feel as though that we're back on the macro front now with US earnings and Aussie earnings season over, is this kind of almost insane desire. And I think that the term that Stephen used was the market's tortured attempts to look for pivots in the language of, and I suppose in the guidance of almost every central bank, and that the RBA, although that they didn't really pivot in any kind of sense, saw that the slightest opening that things could sort of back off a little bit, and it gave risk assets an excuse to rally, which of course, obviously will, as we've sort of discussed in the past, and less so in Australia because the transmission mechanism is different, but in the States in particular, if the market starts to rally and financial conditions loosen again because, the language is seen to be, maybe ambiguous enough to open that door, that creates a situation where things are still too accommodative for the Fed, and they have to, obviously react again by being even more aggressive in their language to sort of push financial conditions to where they want it to be. So for me, that's the two things. You get your micro with the earnings season post-mortem, and then the macro with the central bank talk.
Yeah, it does seem like the markets really needed an excuse. First off, they needed an excuse to come off after Powell didn't pivot, and everyone was ready for what happened. I personally, if I was going to throw my hat into the ring, and I do because that's what I get paid to do, I think that we're going to get rug pulled again to the downside on this one. I've just been looking at the data and seeing exactly what's going on. The markets will have more of a reason to sell off as the Fed continues unabated into what it's doing. Powell does not care. He'll keep on going. Probably a little bit higher. And you've seen what's happened in Europe as well. 75 last night. Going to be another 75 again soon. It's that will be unstoppable as well. Everything until China really starts to wake up. I thought the market would probably come off and then we'd be buying into the end of September. I'll go into that with Heath Moss a little later. Anything else going on in your world, mate?
Yeah, I mean, I suppose we've got a lot of currency folks coming in trying to talk about what the US dollar is going, what the US dollar is doing and what it could potentially mean. And the other thing that has been really interesting recently too is that, I mean, I'm trying to drag, I think we were talking about this last time, that the lack of conversation around what QT could mean. But I'm still trying to drag in a lot of guests to talk about exactly that and some rate strategists. And I actually had a really good chat. This was probably 3 weeks ago now, though, with Joseph Wang, so aka Fed Guy for folks who are out there. And his whole push being that the markets are really, really bad at pricing and regime change. They're not appreciating, obviously, what the Fed is trying to do, and then also don't appreciate the kind of wave that's going to come through the markets when quantitative tightening actually takes effect, which, as I'm sure you've discussed recently too, Wills, is that it's only really picked up pace in the last couple of weeks. It's been a drop in the ocean when it comes to balance sheet normalization. So that's probably the other thing too, which, probably like you were just saying before, James, suggests that there's another leg down because financial conditions can tighten a hell of a lot more from here.
Yeah, that's right. And funnily enough, we're going to go into this. I'm going to be able to link this through with what we're going to talk about with Johnny in just a few minutes. That with regards to the next leg down is probably going to be from what we're going to see in the tech space. An amazing stat that I had out this week was that the S&P 500 is trading about 16.5 times, which sort of seems fairish. However, the top 10 stocks are around 24 times. It's still really, really high. If you take those top 10 stocks out and just have the S&P 490, it's about 14 something times forward earnings. Which is now suddenly starts to get a bit more fair. Those big top stocks are still keeping the market as a whole overvalued. That's a sticking point for me at the moment. Although I do like tech and I like quality tech, there's a point when I need to be a buyer, and I'm not sure that this point is exactly that time. All right, cheers for that. We're going to throw now to the head of sales at OpenMarkets, Ian Aspinall, good friend of mine, good friend of the show's, has done a lot of great work for us, has made himself a subject matter expert of sorts in this field of advice with the advice changes that are coming up. A lot of people talking about some stuff that happened this week. And a lot of people talking about the changes of advice that will be going forward this year and next year potentially. Mate, I'm just going to hand it over. Ian Aspinall, go.
James, thanks for that, mate. Hey, there's the saying, may you live in interesting times. Well, we're certainly living in interesting times for Australian financial services regulation. So there's a couple of things that have come out over the last month or so, particularly around crypto and advice. I'm going to jump into crypto first. So first off, people should realise, especially if you're sort of dealing in crypto for DIY investing or the like, the Australian government is actually proposing that that crypto assets are excluded from being treated as a foreign currency in Australia for income tax purposes. So foreign currency in Australia for tax, you'd have to actually bring the currency back to the Australian dollar to report your income. That's not going to be the case moving forward. It is subject to a Treasury consultation paper, but that won't be the case moving forward. The main driver of that is actually the government of El Salvador adopting Bitcoin as a legal tender. And also there's a place in Argentina, Mendoza, which is a province that's now actually collecting crypto for tax purposes. So that's really pushed the Treasury Department into making sure that crypto is actually treated in a different way when it comes to income tax purposes. Obviously, we're all aware that the exchanges that deal in crypto here in Australia now must report you into the Australian Tax Office if you're trading crypto. So you're not going to get away from the income tax that comes with that. Now that flows on into the Treasury Department's consultation paper discussing how crypto is actually going to be regulated in Australia. Currently it's only subject to the APRA requirements of the AML CTF requirements, and that's the counter-terrorism and money laundering requirements. So what Treasury are looking at doing is actually making crypto a financial product in Australia, and that's going to operate under a new single licensing regime. So it's going to be separate from the existing Australian financial services licensing regime, and they're talking about what they call crypto asset secondary service providers, or CASPers. And those CASPers are largely going to be defined as somebody who's an exchange, a service that offers transfer of crypto assets, a service that might offer custody in crypto access, or anybody who participates and provides financial services relating to a crypto asset. Now, the government is intending on putting the same sort of obligations that an Australian financial services licensee has on these CASPers, but it's looking like it's going to be a separate product. And again, this is really most probably an interesting point for your investors in self-managed super funds, because once it becomes a financial services product and it's regulated, then obviously there's going to be a lot more use for crypto within the Australian investing landscape.
Yeah, spot on. And this does go back to a podcast I had with, where was he from? RMIT expert, whose name has eluded me, but he was talking about this was the next big jump that was needed in the crypto space to normalize it and get it into hands as a normal asset. So this sort of is a step in the right direction, I believe, as far as we're conversing that day.
Absolutely, but I think the term normalisation is an interesting one, James, because ASIC's just recently come out with a warning to what we might call Robin Hood style brokers here in Australia, who are providing sort of low cost brokerage, and their warning to those Robin Hood style brokers is this addition of new features such as things like security lending and cryptocurrency investing, and essentially what ASIC is saying to these AFSLs that are providing these services is they're concerned about bundling high risk offerings as a way to soften their low revenue basis from low cost equity trading and giving the appearance that crypto is actually as safe as equities. So ASIC have actually come out, even though crypto is not regulated by ASIC, and again, we've just spoken to the fact that we are looking at crypto becoming a financial product, but ASIC have come out and basically to put brokers on notice to say that their decision to offer unregulated crypto trading alongside regulated financial products like shares on the same platform may provide investors with a false sense of security. So this is something that those Robin Hood style trading platforms are looking at right now, and ASIC are scrutinising these claims for zero or low cost brokerage, where maybe those zero or low cost brokerage are being supplemented by items that have got a higher risk or a higher charge associated.
Okay, I can sort of follow that. Now, what else was going on in the advice stuff that was going to be changing?
Yeah, sure. So then what you've got is you've got the levy inquiry that's come into the quality of advice, and really what the levy inquiry is talking to is about how to make advice more affordable and more accessible by the Australian public. Now, this review is not completed, and Levy needs to actually go and do a review of the insurance industry and come back with the suggestions from there. And we're going to end up most probably another consultation paper that will go around it. But look, a little bit of history. The Future of Financial Advice reforms back in June 2012, FSR back in 2001. Those two reforms introduced statement of advice, SOAs, record of advice, ROAs, the best interest duty, opt-in, fee disclosure statements, conflicted remuneration. And that's really provided a large cost to the people providing advice, who then have got to pass that cost on to the consumer. So what Levy is trying to do is introduce a best advice sort of duty, and that best advice duty is going to allow, hopefully, the cost of advice to be reduced, and that could be either in one of two ways. One is it will strip out the general advice provision, so you will have either personal advice or you'll have this best advice duty, and by stripping out a lot of the compliance regime to do with things like safe harbour, best interest duties, all that type of stuff, hopefully that will bring the cost of financial advisors providing advice down, and those costs will be able to, or those savings will be able to pass on to the end consumer. The second component though, and look, we've got, for example, a stochastic modelling solution here at OpenMarkets we call OM Advice. What will happen is those digital platforms or algorithms that run digital platforms are actually going to be subject to that best advice duty as well. And the important thing about that is that may allow banks, fund managers, or insurers a way to provide simple advice to consumers that wouldn't necessarily have to be provided by a licensed financial services advisor. So, case in point, you could use a stochastic modeling or a digital advice platform. Again, that platform is subject to the best advice duties, and a non-AFSL authorised rep may be able to use that system to provide advice to a consumer at a much lower cost, taking out those safe harbour or those best interest duties that normally would be applied to a financial advisor.
Yep, that's which is pretty good. So the ability to automate it, make it more achievable, make it cheaper, because a lot of people, a lot of retail clients in the market have really had advice taken away from them. Too expensive, or people just don't want to touch it because it's literally just it's too hot, it's too dangerous to be able to take the risk and go into it. For what's relatively,
I think a combination of both the FOFA reforms and also the Haynes Royal Commission. I mean, we've seen advisor numbers drop from about 27,000 advisors down to about 16,000. And we were just throwing some numbers around the business the other day. We think that that's about a 7.5 million hours of advice that has been removed per annum from the Australian financial services landscape. Now, some of those people should leave for the right reasons. Some of those people might have left for the wrong reasons.
Yeah.
But certainly the problem is when you remove that amount of advice from the market, then obviously the cost of advice is going to go up. And it really does become the domain of high net worth investors or people who have the salaries that can support the $3,500 to $4,000 it costs for an annual review. And that's an annual review. We're not talking about people who need advice on a 6 monthly basis or a quarterly basis. Those costs even increase there. Okay.
So, yeah, it does seem like it's normalising the industry, which is good, and not swinging it too far in the other direction. But I think that we can all agree that there has been a pretty big burden on the advising space for the last few years that I think we've been managing to deal with as best as we can, because it's our career and our jobs and we love it. But yeah, it does seem like it's a step in the right direction here.
Absolutely. And we look forward to it, because I think it's about time that the onerous burden that we've had through regulation, and look, there has been reasons for it, but now it's time to normalise it. It's time to get it into the hands of the average Australian, and hopefully the average Australian will be better advised.
Yeah, that's right. Now, what was the timeline on this one?
So the timeline, it's still subject to the review process. Again, Levy's still actually got to look at the insurance side of life. Yeah. I think you'll most probably find that the recommendations or the review will be suggested up to government most probably middle to late next year, and then we'll see the outcomes from there.
Excellent. All right. Well, anything else to say? Otherwise, we'll move on with the show.
Thanks, James.
Good on you, mate. Mate, switching straight over to National Sales Manager of Our Kloud. And whilst, you can go ahead and plug his company, go nuts. I was having a fascinating conversation with him earlier in the week. Jonathan de Boer, mate, first off, front row centre, how are you now?
Good, buddy. Good. Good morning.
Thanks for joining us. Good morning.
Glad to be on.
We were talking a few days ago just about some of the fascinating stuff. First off, what do you do and how do you make money is the way that I always want to introduce my guests so that people know who you are.
I'm a national sales manager for a company called Our Kloud. We sell sort of ICT services, managed services, and I run a sales team across Brisbane, Sydney, Melbourne and Perth.
Now, we've noticed that there's this huge shift that's going on, sort of, it's a weird generational shift, I guess you could call it, of people who are making the shift out of certain industries into tech, potentially being lured by the size and the swell, and people are making moves inside tech as well. The job shifting and the payments and the bonuses are pretty exorbitant. And you had a few things that you just wanted to mention about that, just for people to be aware of and people to be warned about.
Yeah, look, I mean, it was a really interesting chat, wasn't it? Just came out of nowhere. But look, I mean, I sort of live with it day in, day out, and I've been in tech for 23 years. So much of my network is sort of built around this world. And you know, during COVID and since then, we've seen an increasing number of jobs out there, specifically tech, primarily sort of sales related. And you know, you're seeing, because of that, people are looking to poach the best salespeople and the best people from different companies. So they're throwing great big salaries at them. which is obviously great. That's fantastic. Everyone wants to earn more money.
We are seeing that in the wages data, yes.
You're seeing it. What you're then seeing is, the average worker is now poking his head up and realizing that, geez, I can put another 50 grand on my base, et cetera, et cetera, et cetera. And so it's really disrupting the market where you're not necessarily buying the best person anymore. You're just trying to grab a body. And you're seeing average people, I mean that sort of with the greatest of respect, earning huge salaries.
We're really sinking the boot into some areas of the industry, aren't we? So
there you go. Just dig them. But and I've sort of seen a few people in my world sort of take on these roles, and what you're finding is that with the big salary comes a big target, and you could find yourself in hot water very quickly. Again, sort of my advice within my network is really, it's a great opportunity to go and move, shift jobs, potentially, earn more money. But before you sort of get swayed by the salary, really take a step back and start looking at yourself. What are your core values? What makes you tick? And so when you go into an interview, you interview the company, right? You're the one with power. Interview the company. Is this company going to give you everything you need to be successful? Because if you're just chasing the salary, in 6 months' time, you could find yourself in hot water.
Yeah, that's right. So how would you recommend that someone actually puts that together? It formalize it in some way. I've been doing it myself just recently and realizing that there's a lot of stuff that I haven't had a conversation with myself for a while about what I want to get out of my industry and what I want to try and do with the remaining years that I have left in this industry, long though they will be. But how would you recommend people actually do that?
Look, I don't really have a formal way of doing it. I believe very much in sort of mentorship and, having people in your network that know you, the good, the bad, and the ugly. I have these conversations regularly with my sort of mentors and people in the industry. To have a brutally honest conversation about who you are and what do you want. I think, again, it's really easy to look at a job advert on Seek or LinkedIn and see a figure and go, I want that figure. But you ignore those things that mean something to you. So for me, for example, I like to work collaboratively. I like to be in the office with people and bounce ideas off. Let's go and spitball that in the pub, and then you come up with this great idea. And I know that lots of organizations aren't like that. You're a lone wolf. And in my world, that doesn't really work for me. So, I think it's that, sit down with a pen and a piece of paper and actually work out or think about what you enjoy and where you've been successful in the past and what has made you successful. Because generally, if you're happier, you're going to perform better, right? And if
you would think so.
If it means taking a salary that's a little bit less, but you're in a happy place, the chances are you're probably going to knock your targets out the park and earn more money anyway.
That's a very good way of putting it. Now, I'm going to bring in the other guys if they want to join us here, Aspie and Kyle, if you want to chip in. Talking about the bigger economic cycle that we're seeing here, we've got inflation obviously through the roof. No real sign of exactly when that's going to start coming back. We've got a market that's overcooked with regards specifically to tech. We've got wages data that's still showing up. We've got people job shifting and people are getting paid more money. However, at the same time, what I'm seeing here is, what was it, Johnny? You were talking about, was it Amazon, Microsoft? Who's got
AWS just have, so Amazon, I think Salesforce have put a freeze on.
This is job freezes.
Job freezes. So you're looking at those massive organizations. So, you're looking at tech and there's loads of jobs out there. And then you're looking at the big boys and they're sort of dialing it back. And so you start looking at this and go, oh, is there something happening here? Because it doesn't really seem to add up. And when people like Salesforce and Amazon take a step back, you've really got to take note of that, right? Because they don't usually do things like that without having a bit of an insight into what's going on in the future. Yeah,
they see the best data as well, which we can talk about. So I don't know, guys. What's your take on where the market will perceive that if we're trying to get on the front edge of this one?
Well,
Kyle?
I mean, I only want to play devil's advocate because I think the best thing that I can ever offer here is just to relay what smarter people than me are saying. But one of the perhaps maybe bull cases or glass half full perspectives was that what we're seeing in tech and the job freezes and the job losses, and to sort of reconcile that with the data that we're getting, which still sort of suggests that jobs growth is strong in the States, unemployment claims are reasonably low, is that we're actually seeing kind of labour mobility. So people that were working in these big sort of perhaps bloated industries, ones that were benefiting during the pandemic as well because everyone was working from home and they were growing very strongly, moving to other areas of the economy. So maybe going back into services, going back into other industries that are sort of short of labour and that can better utilise them. So again, I'm not an economist. I don't know. But the one, maybe the counterpoint to some of the doom and gloom out there is that it's labour mobility rather than, maybe jobs being lost. Maybe that's just wishful thinking.
Yeah. Jono, anything to chuck into that one?
Look, not really. I don't disagree. I guess I sort of sit in a tech world, and I think it is a good opportunity. I might have come across a bit negative. I think it's a great opportunity to get out there, earn yourself more money. But, before you run into it, go and find something good, something really exciting rather than just the cash. But, there's definitely, it is an interesting time and, go forth and multiply.
Okay, all right. Well, I'm going to have to wrap it up there unless anyone has got anything else to add. I'm going to talk to Heath Moss from Heath Moss from HLM Investments in just a moment. So thanks for joining us there. Kyle Rodda from Ausbiz, Ian Aspinall from OpenMarkets, and Johnny de Boer, I'm never going to be able to pronounce that right, from Our Kloud.
Thanks, mate.
Thank you.
Good on you guys. Talk to you later.
Bye.
Okay, we're going to get on the show now, and I've got Heath Moss, principal at HLM Investments. Heath, how are you now?
Very good, mate. Very good. Thanks for having me on again.
Mate, I've got all sorts of crazy data coming out of the woodwork on this one. I'm looking at freight data that's coming way back down. It was at $10,000, I assume, per unit. I'll put that some links onto that. I'm also seeing huge put buying activity, the sort of stuff that scares the Christmas out of people. This is on Sentiment Trader. 22 years of doing this, none stand out like this one. $8.1 billion worth of put options. And only $1 billion worth of calls bought last week by institutional traders, 3 times more extreme than 2008. You've got a market that reacted positively over the last couple of days to the same sort of negative sentiment with regards to interest rates going up that spooked the market a couple of weeks ago. What are you seeing? How's it going?
We're in a precarious position at the moment in the market. I think the market can't really make heads or tails of what's going to happen with this inflation and rate situation. It's the uncertainty that really the markets hate. And, the market, we had yields in that come off about a month ago or so when we had those June lows. And it looked like, we were going to get a pivot or a pause or something along those lines. And Jay Powell at Jackson Hole the other week just sort of totally dismissed that. And even here in the RBA was extremely hawkish in their meeting and their notes of their meeting, although they did give some reprieve yesterday in their speech, Governor Lowe. He did signal that there may be a pause or at least a slowing of rate rises around the corner. So I think that's where we've seen a bit of positivity come back into the Australian market.
Yeah. It was a light local pivot, I would say.
Yeah, but I'm surprised by that's the first time I've seen that heard that put data. I mean, looking at the markets at the moment from a technical standpoint, they're holding these trend lines and have bounced off of them. And I can see like the S&P 500 moving back up to that 4,200, where the next set of resistance is. The XJO moving up to back above that 7,000 mark again. But September generally is we generally tread water, maybe drift down a little bit. There's a lack of news here in Australia. We've got all of the corporate news out with our earnings, etc. And then we just basically wait for October and the third quarter reports and updates of how our company trading is going for this financial year, which I think is going to be really, really important because it'll give us the first signal this year of how the consumer is going with some of those rate rises which have now flowed through to household budgets.
Yeah.
They fully haven't yet, but how some of that is impacting our discretionary spending moving forward.
Yeah, and I mean, a really good note that should be noted. A note that should be noted. Yeah, I'm a wordsmith. You can tell that I do this for a living. Gareth there put something out on Monday. I've been talking about it all week. Anyone who hasn't read it, you've got to read it. I'll link it up on the website on Whelan Capital, where you can see what's going on there. 25% of the mortgage book is CBA. Sorry, 25% of the country's mortgage book is CBA.
Yep.
They see data fairly well. There's only a few other places that see data pretty well. I can mention them later on, but. Gareth's assessment of exactly what was going on with the pain points. So CBA, from the first rate rise, so not the first one, but the first one that people started really worrying about, the 25 basis points in May. From there, then you get a message. So the bank takes a few weeks to then say we're going to raise the rate on your actual account. They give you 32 days notice after that. It's really a 3-month lag. So it was only last month that people actually started to feel 25 basis points on their account. That's why we haven't had that immediate consumer discretionary shock that a lot of people initially said that we were going to get. Now, that really needs to be taken into account. Now, this that we're moving into, this is going to be the spring of our discontent, if you want to talk about what's going on. I think consumer discretionary comes off a cliff. I think people just will not spend at all, regardless of what's going on in the jobs market, regardless of what's going on in wages. Physically, mortgage numbers are just going to be too high for people to actually be able to deal with. What are your thoughts on that?
Yeah, I'm not as pessimistic in terms of discretionary spending as you. I think Australian households are in a very strong position. Savings rates are still high.
Speak for yourself, man.
Historical. And like you said, it does take a while to flow through. I think the RBA will pause before Christmas and give households a breather, allow data to catch up, allow them to get a gauge of things going. Because the last thing you want to do after what we've been through with COVID and all the money was spent, the hundreds of billions of money spent, is to destroy demand so that we head back into recession and have to almost do it all over again. Yeah, I think that's the worst thing we could do. We've got to find that happy medium of where we pull back demand and so we don't get that too much demand push inflation, which I think the RBA is really worried about coming forward because Australian households are in such a great position. Because at the moment, I believe in Australia, most of it is supply push inflation at the moment, with demand push to come from wages and, a really, really tight jobs market. Our jobs market here is so much more tighter than, the US or the UK or somewhere like that. Yeah. So I think the retail discretionary stocks have mostly factored that in. You look at JB Hi-Fi or a Harvey Norman or something, they're all trading around 10 to 11 times forward earnings here. The earnings will come off and slow over full year 23. But I don't think it's going to be a cliff. I think the Australian household budget is in fantastic shape.
Yeah, no, it almost certainly is. I mean, I can't really disagree with you on that. I mean, just like I said, speak for yourself though on those ones. Now, what sectors? Now, keep in mind, we've got it gets closer and closer as I keep on talking about it. I've been talking about it all year. I've probably been talking about it from last year. I've started to see it. I love when, and I'm definitely not saying that I'm the one who started this, but I love it when I talk about some stuff for a while and then I start to see it come up from very serious people on Bloomberg and things like that. The People's Congress in China does start in a couple of weeks, 22nd of October. I've got here in China. Xi will be given the nod for another 5 years or made chairman for life, whichever one it is, it doesn't really matter. That my thesis goes that 10 minutes after that happens and probably even into the lead up to that as more people start to say exactly what's going to happen, that China overcompensates massively for any of the misses that they've had for the year and last year with regards to their COVID zero policy. COVID zero starts to get unwound and it's off to the races and it's a long copper and it's a long iron ore and it's a long everything situation. And China gets us out of any hole that we're in. What are your thoughts on that?
100% on board with you here. We only saw this week the Secretary of the NDRC saying stimulus would accelerate in the third quarter. Yeah. You've already seen 3.5 trillion yuan of specialty bonds sold through to August, mainly for the construction and the infrastructure sector over in China. It takes some time for that to roll through and things to actually start getting moving on the ground. I think after October, we had to have that national conference. He gets his lifetime presidency, and it's all on. Then steel mills start cranking up again, and they really start moving because much like Australia, their economy relies heavily on construction and infrastructure, providing jobs and the common prosperity theme. They can't have that without construction and infrastructure booming. So I think full year 23 is going to be huge for China, and that's obviously a resources play. It's all about, copper and things moving forward. So, yeah, and I think through all of this, I think we need to take note of lithium in China and China and the spot price of lithium in China. It's maintained a price of around $70,000 US a kilo.
Really?
A ton.
I hadn't been following it so,
this whole time. It did get, I think it peaked around 80,000, came off down to the low 60s, and it's still now at 70,000. The sales of electric vehicles over there are still through the roof. They cannot get enough of lithium. And that whole, Goldman Sachs note that came out that said lithium prices are going to drop by 80% by 2023 just does not look like it's going to play out. And lithium stocks, you look at Pilbara Minerals cracking new highs today around the $4.50 mark. They got down to close to $2 a couple of months ago. So you could have easily doubled your money there. But and then we have a company like Mineral Resources coming out today saying, we're thinking about spinning out our lithium assets onto the ASX to realise their full value. But, we're not far along enough to make an official announcement there. So that looks like that's going to happen as well. So lithium is booming, and uranium. Uranium has come to the forefront again. You've got the US with their new inflation package, which is supposed to suppress inflation, but will probably push it higher. There's a lot of uranium and green energy incentives in there, so we've seen uranium stocks move up quite aggressively over the last week or so. I mean, Paladin's moved, I think, about 30% in the last week.
Yep.
So stocks like that.
And you got BOE. BOE was in your arena too, wasn't it? So nothing new under the sun with that one. I prefer, because I'm an international guy, ISO Energy. They've got one of the best grades, best deposits of uranium over in Saskatchewan.
And just to follow on, I think last time I was on, I mentioned Havilah Resources based on their copper project.
Yep.
And the Oz Minerals agreement. And full disclosure, we've got I own them personally, and so do clients. I'm advising on them. But they've also got a nice little uranium project that sits really close to BOE's, Boss Energy's Honeymoon project here in South Australia. They're also looking to spin out. Yes, they're also looking to spin that out as an IPO. So keep an eye on that. So it's sort of not many people know about it. It doesn't seem to be getting much traction.
Well, so know about it now. So
Havilah Resources as well.
HAV trading on the ASX. That's the big general advice only. I don't need to tell you about how this works, guys. Do your own research, do your own homework. Any other sectors that you're looking at on the way through, brother?
Mainly looking at those inflation hedges still. I think in Australia, with no chance of a recession here in the next, say, 18 months. So rates will continue to grind higher. So looking at those stocks that sort of offset that, Woolworths, Transurban, even like a Charter Hall Whale REIT, CLW is their code. They all have inbuilt structures where they offset inflation and actually benefit from it in the longer run. So I've started adding more of those to client portfolios over the last couple of weeks. And I think that's not if you're sort of a longer term investor, looking at those sorts of things as well.
Excellent. I have been myself adding to. So I've got a lot of cash on accounts. I downgraded positions from an overweight sort of invested to being an underweight invested. So still invested, but just having more cash on accounts and still diverse and across the board. So it's caught the rally quite well. It was protected quite well during the savagery of the last couple of weeks, though. So that's been good. What I've been doing is I'm adding that money into the market, into the bonds space, just allocating and just accumulating there. Happy to keep on adding either up or down, depending on which way it goes. But just going to eventually, and this is my goal, is for balanced accounts for whom it's appropriate, I'll be by January looking at maybe being completely 60-40. And
the old 60-40.
Yeah, the old 60-40. It will have an amazing couple of years after this year. Now it's on track for its worst ever. The 60-40 portfolio on track for its worst, obviously with equities and the bond market take a bit of a hit as well with yields rising. So that's now probably going to switch around and reverse. So I want to make sure I've got a really good bond allocation going into next year. And that's only for the clients for whom it is appropriate, which is most of them. And that's a 60-40 that would only be for a balanced account. Check your statement of advice. And if you listen to Ian Aspinall, then, man, what's happening in that advice space is going to be a lot of fun over the next year or two.
Huge changes coming possibly.
Yep. All right, mate, with nothing else to talk about, I'm going to wrap it up and get some editing done.
No worries. Have a good one, mate.
And you too. That's me. That's the end for the show. You can find us on iTunes, The Dip Show, wherever you get your podcasts. Check us out on Twitter. I've also got all of this stuff, and wow, we've got a lot of stuff to get through. I'm going to chuck it all up onto the website, Whelan Capital. It's where everything is. Thanks for joining us. I am at James Whelan 42 on the Twitter. Heath is at Heath Moss 83, I think.
Yep, correct.
And look, the show is produced by, it's produced by me. No secret on that one. I get it done quick. We'll get this out this afternoon. So make sure you do your HAV buying before this hits the streets, mate. I'm just kidding, obviously. Now, we'll catch you next time. Thanks for listening.
Have a good one, everyone.